Money is very important in our life. In today's video I will tell you about stock market. Before going further in the video, please subscribe to my channel and press the bell icon. Let's start. The stock market is one of the best ways for the average person to grow their wealth over the long term. It's nothing to be afraid of, despite how complicated it seems. If you educate yourself, it's possible for anyone to successfully use the markets to reach their financial goals. What is the stock market? The stock market is the collection of company shares that can be bought and sold by investors who trade on exchanges or over the counter. It's also global, with countries like the US, Canada, the UK, Germany, Italy, France, Switzerland, Norway, Australia, Japan, and China all having well-developed stock markets. As of Q1 2022, the total value of the global stock market stood at $108 trillion. Why does the stock market exist? The earliest version of the modern stock market started in Amsterdam in the 1600s. Fundamentally, the stock market exists to connect investors with companies who need money to expand or operate their businesses, more than just a way to make money. It's actually a beautiful creation that facilitates the growth and progression of society, and the development of new products, services, and technological innovations. How does the stock market work? The stock market is built on an interconnected network of stock exchanges, example the New York Stock Exchange, NASDAQ, financial intermediaries, technological infrastructure, and investors. Every day, trillions of dollars worth of company stock and other financial securities change hands. As investors allocate capital, why you should invest in the stock market? If you are watching this video, you've probably already heard some reasons as to why you should invest. While everyone's reasons for getting involved are different, from my own 10 years of experience investing in the market, there are several reasons you should consider starting. To increase your wealth, for most people, the number one reason for investing in the stock market is to increase their wealth. No matter if you are an individual or institutional investor, those who invest in the stock market do so with the expectation they will have more wealth at the end than when they started. Most people intuitively understand that investing in the market is a great way to build general wealth, but many don't appreciate how it also helps shield your money from inflation. Consider that over the last 100 years, the market has generated a 10% annual return while inflation has ranged between 0.12% and 4.7% over the past decade. But keep in mind that past results don't guarantee future returns. To fund your retirement, attached to the goal of growing your wealth is being able to retire or not rely on someone else for your ability to live. Not many people know that retirement is a relatively new phenomenon that began with the wider adoption of pensions in the early 1900s, when the retirement age was pegged at 65. Nowadays, retirement has become the dream for many as they look to escape the rat race. To save for a house or other big purchases. Investing can also be used to fund big purchases like a home, the education of your kids, or another big future purchase. Here, your investment time horizon becomes important, as investing to fund a purchase is a more short-term goal versus retirement. This is where your investment strategy and the amount of risk you take comes into play. According to conventional wisdom, you should have at least a 5-year time horizon when investing in stocks. To have fun with your money, funding your retirement and increasing your wealth are important reasons to invest, but they can also be, well, boring. The market is an amazing mechanism for long-term wealth building, but it can also be a way to have fun with your money via trading, so long as you do it responsibly and don't risk more than you can afford to lose. Don't, however, confuse short-term trading with investing. They are not the same thing, and trading often results in losses. How to determine your investing strategy? Once you've determined why you are investing, you'll need to decide how you want to invest. Generally, there are 3 decisions you need to make when it comes to shaping your investment strategy. 1. High risk or low risk. Understanding your risk tolerance and risk capacity are 2 of the most important things you can do when investing. Risk tolerance is your emotional stamina to take on risk and incur potential losses to meet your financial goals. It's a choice that you make. Risk capacity is your ability to manage losses financially. There are no free lunches in the markets, and there's always a risk that you can lose money over a given period. That's why building your investing strategy around your risk tolerance and capacity is the best way to minimize the inherent risks of investing. Conventional wisdom says that the younger you are, the more risk you should take, but that doesn't mean you should become a day trader. A higher risk investment approach could mean focusing on specific sectors like technology or biotech. Being more active versus passive, or choosing individual stocks versus broad and diversified investment funds. 2. Active or passive. Active investing involves frequent trading and adjusting your portfolio to generate higher returns than the market. This is the job of professional portfolio managers. If you are an active investor, you'll be spending a lot of time paying attention to your investments and doing lots of research on what you invest in and how much you allocate to each holding. Active investing is meant to bring about potentially higher returns, more flexibility when markets get tough, and tax advantages. Overall, it's much riskier, more expensive, and takes up a lot of time and mind space. Passive investors often look to replicate the average returns of market indexes, like the S&P 500 via index funds. A passive approach generates lower transaction and other investment-related fees and can also be lower risk, depending on what you invest in. 3. Start investing in the stock market with little money. When it comes to investing in the stock market, cost is often the barrier to entry. It takes money to make money, right? Not anymore. The internet has made it easy for consumers to get started with very little upfront money. That means you can put a few dollars in to familiarize yourself with investing before making a bigger commitment. It's a great way to learn about investing while putting very little money at risk. Today, there are increasing numbers of options that have swung open doors to a new generation of investors, letting you get started with as little as $1 and no trade commissions. In the past, stockbrokers charged commissions of several dollars every time you bought or sold stock. That made it cost prohibitive to invest in even a single stock with less than hundreds or thousands of dollars. In fact, $0 commissions have been so successful they've disrupted the entire investing industry and forced all the major brokers, from E-Trade to Fidelity, to follow suit and drop trading commissions. Plus, the ability to invest in companies with fractional/partial shares is a complete game changer with investing. With fractional shares, it means you can diversify your portfolio even more while saving money. Instead of investing in a full share, you can buy a fraction of a share. If you want to invest in a high-priced stock like Amazon, for instance, you can do so for a few dollars instead of shelling out the price for one full share, which, as I write this, is around $2,434. Thanks for watching my video and giving your precious time.